Hello, ladies and gentlemen, and welcome back. Well, it's 2023, and that means that we need to discuss stocks, commodities, and cryptos for the year ahead. We also need to talk about this level and this specific market. And the reason why is simple. Options, and it's Wall Street versus retail. Who is doing what, and what does it mean for us as traders and investors over the next couple of weeks and days? We also need to talk about one other thing, the FOMC minutes and what it means for recessions and also PE valuations into 2023. A lot to discuss, heaps of good information. See you soon. Well, welcome back, everybody, to the Daily Show where we discuss markets around the world. We've got the news, the macro data, the lead indicators, and of course, the key charts that you need to be watching right now in today's show. But we'll start off with the FOMC meeting minutes. And as we saw, participants continued to anticipate ongoing rate increases. What does this mean? Well, if we have a look at an updated Federal Reserve dot plot expectation of rate hikes, basically they're expecting to get anywhere between 4.8 and 5.25% on the terminal. That means that this year, that's where the interest rate should be going. And then there'll be rate cuts coming through into 2024 and 2025. Now, why are they rate cutting? Because the damage that they're doing right now to combat inflation is going to have significant ramifications. It's part of the reason why the market is down right now. And it's also part of the reason why things like Tesla and other big growth stocks have been taking a battering recently. We've got our thoughts coming up on the show a little bit later on that one. But here's one of the most important charts to be thinking about in 2023. And that's got to do with PE or forward PE ratio valuations. We know that this is where markets become, let's say, cheap versus expensive. And we're sitting at the time of this recording around 16.7 in terms of forward PE. Now, historically, this has been a fairly decent price, but if you notice some of these dips, sometimes forward PEs get into significantly lower valuations, 14, 16, 10.4 during the global financial crisis, and during the 2020 crash, 13.3. If you ever see forward PEs go down past a standard deviation below, which we'll look at in a second, it can be an incredible time for you to think about markets as an investment more than just a trade. Now, of course, you need to practice your own risk management, but this is just statistics and what's been shown over the past history. Now, if we scroll over to our FX Evolution, follow us on Twitter page over here, then you can see that I've posted a couple of really interesting charts. Here is a Shiller PE, which is more of an average over time valuation versus, of course, the forward PE currently of the market and the 25-year average. So we've basically returned back to the 25-year average. Is the market cheap? No. Is the market expensive? Historically, it's kind of fair value. So we start 2023 at what we would call fair value for the market. Now, if it gets down to a standard deviation lower, say a 13.47, this is going to be a chart that you'll need to watch in 2023. So make sure you subscribe to this channel because we'll be following it over on Twitter and of course YouTube here and in our Discord community, links in the description down below if you're interested. Another thing that I want to bring up is the options market. And this is super important to understand. As we know, options realistically makes the world or makes at least the markets really move a lot. And when small traders are all doing something, we need to be a little bit concerned. So what have small traders been doing over the last couple of weeks? Well, they're spending tons of money buying puts and not buying calls. I'm sure a few of you out there probably own a few puts in the markets right now. And after today's video, you'll see some key levels where maybe it's not the best time to buy puts in these markets. It seems like it is because the markets have been falling off, but historically it's very tough for markets to go lower when these types of things happen. We've got some more charts on this coming up in today's show. So take a look at this. This is the last couple of crashes in markets. The 2000s, obviously the tech bust. When small traders all got bearish, the market went sideways. We've got the GFC, and I'm going to be focused on this one over here, the global financial crisis, a big sell-off, focused on a huge amount of dots that come out through here, a lot of sideways action, kangaroo style, and then a final fall off. Now, this is one of the leading theories of 2023 so far, a market that stays in a kangaroo mode where it basically jumps up and down and all around, and then hopefully does what we call a capitulation, which leads into ideally a rally after that, and hopefully a pullout for the US economy and rest of the economies around the world. So if we go with that theory, let's think about why some of these things are occurring and why we've got to be scared a little bit about some of the stock valuations in the market. And this is the first one: personal savings as a percentage of disposable income in the United States. Now, the data's a little bit old here. It's only up to June 2022, but we have another survey coming up in today's show that'll make sense here. And you have to expect this to be even worse now. So where is everyone's savings? Well, they're really bad. Basically, they're worse now than they have been for the last decade. This is not a good thing. We're going into most likely what's going to be called a recession in 2023, and we're going into a fairly tough time in terms of interest rates. We also know that everybody's starting to struggle. Here's a recent survey that's taken talking about emergency fund saving crisis. And unfortunately, as you can see here, the demographics, if you pause it here, are not so great. The amount of emergency savings is very low for the average American, and less than 500 is pretty disturbing. It's actually very high. So this is going to be one of the stories. We have to expect that consumer discretionary will continue to struggle and valuation concerns will come in. So remember that Ford PE valuation that we saw before. That's expected to probably compress further, and that's why we're seeing so much emphasis on quarter one earnings for 2023. You're going to have to really be on top of Q1 and Q2 earnings because of these reasons out there. If we scroll through, why do we think a recession's coming? Well, we've discussed this so much in 2022. Whenever you have 50% of bond yield inversion, which we don't have on this chart, but if we ever see that, you pretty much have had 100% since the 1970s chance of having a recession called. We also now see, of course, services activity ISM and manufacturing activity ISM dropping off a cliff. And this usually has happened leading into tougher economic times and traditionally into recessions being called. So, of course, it's more likely than not that that's occurring. So with all of this bad news, is there any good news for markets or traders? Well, yeah, there is. Sometimes when everything looks really bleak, everybody turns incredibly bearish on markets. And that's actually a time where a trader has to step in and they have to be able to see something that I always say, which is the forest from the trees. What do we know right now in terms of data or stats? What do we know? Well, we do know that unfortunately everyone's turned bearish recently. Small trader put buying has realistically increased at an astronomical rate. You can see here that put buying has just crossed a threshold that we haven't seen in a little while. If we scroll over, you'll notice here the chart that I shared over on Twitter, and it shows that call premium versus put premium is certainly at a lower point. Again, notice some of the previous crash periods in the SP 500 and what happens afterwards. When we get these readings, we tend to go into sideways style markets or even recovering style markets. It's very rare that we continue to drop off. Here's another one where we take a little bit more of a kind of closer look at it and we break it down a little bit more. And we've seen this happen a lot in 2022. And remember the global financial crisis. We saw a reading like this. We saw a kangaroo style market where it went like this, then it dropped off heavily, and then it recovered afterwards. We got that capitulation. Now, one of our leading theories here on the channel throughout 2022 and 2023 is we haven't seen the VIX, which we'll look at later, go above 45. The VIX, or the volatility index, is usually something that we see reach a very high level during a fearful time, and that tends to mark potentially bottoms in market. Even though at that period it's going to look terrifying, there's going to be nothing good in the world. Generally speaking, that is an interesting time. Remember, Buffett says, buy when others are fearful effectively, or be greedy when others are fearful. Well, is that going to happen in 2023? It seems like it could, and even these data stats are pointing towards that being still a possibility. Small trader put call premium, again, if we're looking at the data and the stats, we've seen readings such as this in 2022. We're getting a similar reading kind of around this area, and what it does show us is that we could be going into a bit of a kangaroo style here leading into Q1 earnings. Maybe let a little bit of expiration occur of the options, which we'll look at in terms of the chain, and then the next fall to occur. So what about down volume versus up volume? Well, we've actually got another reading here that kind of points towards potentially a temporary buy that could be coming in. We've had some thresholds being reached. We've seen similar thresholds being reached in 2022, and this led to small upticks in the markets. Of course, it did show bottomings over these periods, but the difference was that each time we got this signal in 2022, we'd made new lows. We have not done that in 2023, the current low that we're on at the moment. So does this point towards maybe a little bit of an uptick now leading into January of 2023? Well, it certainly could do so. What about from the bear side? We always like to present both opportunities here on the markets. Well, for the bears, it's a good kind of thing that markets are starting to make new lows on some of the big stocks. When we've seen that historically, while we may rally afterwards, notice the rallies that happened over here. We got the sell signal, then we got the rally, then we got the dump. That's something that we're seriously considering here, rally, then potential dump later on. This is something that did occur. Here are some of the stats for what actually happened in the weeks and months afterwards. Of course, very negative types of runs tend to occur off this point in the market. We also had the MACD switch that helped us to try to define this recent sell-off that we've seen in December, and that's been very, very good. And of course, it tends to lead into the next couple of months as well. You can see here the statistics were never good for the market leading into 2023, and it's been one of the reasons that we've been, relatively speaking, bearish on the markets currently, and probably maintain our bearish status into 2023 even during rallies. Let's have a look at the markets now. We'll start off with the VIX, or the volatility index. This is the one where we're talking about the idea that maybe we'll get a 45 plus in 2023. We need to remember that some of the leading theories are that in 2007 leading into 2008, we didn't see a market that really breached 40 from the VIX. That actually happened in 2022 again. We know that these types of historically large fear levels tend to mark or get close to marking bottoms in markets. And we haven't seen one of those in 2022. So the VIX remains at 22. It's neither high nor extremely low. It's still above 20, which means theoretically you're still holding in that kind of bear market territory. We'll continue to follow this, but that's where we're at the moment. Now, I've seen a lot of people message me with this chart, and they're saying, Tom, look at lumber. We need to check out lumber. Lumber predicts all recessions and all bad market periods. Lumber's pretty good. I mean, it obviously shows housing more than anything else. And some people use lumber gold and some other ratios out there. I wouldn't say it's a forward predictor so much, but yes, you can see here that lumber has fallen off a cliff from where it was up with these massive highs back in 2020 and 21. We've seen lumber fall all the way back down. And if you think about it with the markets, oftentimes when lumber has crashed, markets have taken dives because it shows that demand destruction is well underway. Also, one of the things you can do with lumber is if you're seeing a bottoming of markets and then lumber starts to recover with the market, that's usually a positive sign. So it's again something that can help you gain, let's say, clarity in a situation when markets are recovering. Is lumber recovering? Right now, it looks terrible on a chart. So certainly one to be watching in 2023. Let's move over to the FOMC meeting minutes. Obviously, we saw them say we're going to have to continue to maintain. We're not changing anything about rates. We're going to continue to basically hike them as we see fit to deal with inflation. And it didn't really change the 2-year too much. We're still sitting around 4.376. But we did see the September go to 4.9. So basically, we're looking at still consistently high rates throughout most of 2023. And until these start getting cut down, as we know, the forward rate is very important at the moment, we're not really going to see a huge amount of yield kind of conversion into bonds and things like that. So we're looking for some of these forward rates to get cut down, and that to show us that most likely the Federal Reserve, or the market believes the Federal Reserve's dealt with inflation, and now we can move to recovering, let's say, the economy, because the economy is being hurt by the day now since these interest rates are so high. Another thing that I think is worth noting is that the US 10-year, while it's at 3.7, some of my lead indicators are pointing towards the US 10-year really starting to struggle moving forward. And that's going to be something that's positive towards things like TLT, which is Treasury yields. A lot of people love Treasury yields. We'll talk about them in a second. But that's something that may do quite well in 2023, purely just based on the fact that during normal recessions, and especially during interest rate cut expectations, treasuries tend to do okay. Let's move over to high yields. We know that junk bonds have been a good indicator of bullish and bearish pressure. And we've seen recently junk bonds fall off a cliff and then, of course, recover in the recent days. So junk bonds are doing okay at the moment. We probably expect these to kind of hover around this area. And if they start to fall and the market's going up, again, what does that tell us? It usually means we've got to be incredibly careful about that rally. So junk bonds, HYG, worth noting on your charts for 2023. What about TLT? What about treasuries? Well, as expected, treasuries fell off. Everyone loved them way too much here. They fell off substantially, and they've actually done a little island reversal here, like they did in the reverse side, towards the bullish end in the recent couple of days. Now, this is a pretty decent zone for treasuries. They fell off a considerable amount. If you took percentage from the top to the bottom, they fell another almost 10%, which is pretty significant. And they got within, if you look at the bottom to here, around 7.5% to the low. So do we like treasuries in 2023? Well, I don't think there's much to hate about them at the current rate. If you go back over expectations of where they've been in the past history, you can see that during economic crisis periods, they've tended to hold their own, not necessarily show incredible gains, but hold their own. And they're well known to be kind of that staple that a lot of fund managers jump into during bad periods. Now, they don't work during inflation, so you have to believe that we're moving from inflationary period into potentially a recessionary, deflationary kind of period here. Do you believe that? Well, it's going to be a big part of TLT moving forward, and we'll go back into that in a deeper discussion in upcoming videos now that we're back from that break in terms of the holiday. And by the way, I hope everyone had a Happy New Year if you celebrate the Happy New Year. And of course, you had a Merry Christmas as well with your family, took a little bit of time off from the charts and got ready for a very good year ahead, I'm sure, for traders and for investors. Let's move over to the dollar index now. We expect this to be an interesting chart moving forward. It did break through new high here. So it actually got through that 104 kind of 50 area, triggered our alerts above this high. And now it's starting to look like it could be accumulating in a position. So we've talked about this level a lot before. The weekly is going to be incredibly key. Where does this weekly close? This is not really the type of weekly close you want if you're feeling bullish on the US dollar. So everything comes down to the weekly close at this stage. Could we be an accumulation or a distribution? We're not exactly sure just yet, because as you can see here in the charts, we know that we have kind of highs. We know that we have lows. We're not seeing significant wick or wick selling off either of them. We did have that strong buying down here previously, and now we're stuck in the middle of the zone. So we'll come back to this one. And the US dollar, I think, is going to have an interesting move on it throughout January, but we just haven't seen the breakout or any significant move just yet. Let's move over to gold. Traditionally, it's a very strong period of time. January, December, November tends to be pretty good for gold. It was again. We saw that kind of series of higher lows coming through for gold, and it's moving, you would think, towards that 1872 kind of for the ounce. That's the area that we expect maybe some sellers to recommit themselves to the gold trade. Now, gold managed to go up while the US dollar was also partially strengthening. So it's interesting to see again that people are betting on that stagflation kind of concept, or at least maybe some interest rate cuts. And I can tell you that gold does fairly well, especially if US 10-year does go down. So if your expectation is that US 10-year is going to decline, gold does tend to do well. It's one of our favorites for the beginning session here in 2023, along with silver, that if you look at it on a weekly chart, it still looks pretty damn good. The predominant part of silver, though, that looked the best was this accumulation down here. I'd love to see it kind of do this later. And of course, we have alerts set for that kind of level. Let's move over now to US oil. US oil dropped through this zone. It still didn't quite meet that 82 a barrel that I was kind of hoping for. So we saw this wick rejection up here, then it moved forward, which we did think would happen. I do admit, I thought it might hit 82 a barrel. It didn't quite get into that area. It just kept getting failings around that 81.50, and then it fell off heavily. So it actually kind of created like a little double topping in here, broke through these wicks, and as you can see at the time of this recording, it sold off aggressively. So for 2023, do we still think that oil can hit 65 a barrel? Absolutely. It's still our longer term, medium term play. We've talked about that, I think, to the death in terms of 2022. I've been speaking about it since 120 a barrel, and we're still getting closer and closer to that point. But if we do rally here, where's the problem, or where's the sellers that might recommit? It's probably somewhere around that 77 a barrel for the US oil. If we go down to the 2 hour, you'll notice that we have those wick rejections. We've got like a little bit of structure that's formed through the 77 as well. So if markets do come back up, this could be an area where sellers recommit themselves. It's kind of like a conservative double top style entry. And also we've got some structure in there, previous support, becoming resistance, all of that good stuff. Did we make a new low? Absolutely. Is this consistent? Well, if we take like even a fib pullback, you'll notice that even with 50% fib, which is probably sitting around here, and then we've got that 61.8 if it goes a little bit higher. So at the moment, we've got to be kind of negative on the barrel. Let's have a look at the weekly here. You can see it's still looking, relatively speaking, weak. And there's not much to like about this. Ideally, at some point, we reach back into this zone, which we've had alerts on now for what seems like eons in this market. Let's move over to the elephant in the room. It's got to be Tesla. Yeah, Tesla is sneaky. We saw that really, well, they call it bad news, which is, of course, the deliveries coming out. That's kind of like earnings for Tesla at the moment. You had to kind of expect it was going to be poor. The reason why is because they were offering those sweet deals. We posted on Twitter kind of early about this, where they were offering massive bonuses if you took your car before the end of 2022. Now, that meant they couldn't quite meet the shipments. Look, they're still doing really well. But the problem here is, and just everyone has to think about this way, this is valuation compression. So the market has crazy expectations of this stock because it's met crazy expectations over the years. Now it's slightly missing on those. And that's why the market's front loading these misses. So that's part of the reason why it's sold off so aggressively. Now, do we still like this area? You have to kind of believe this is a chance where dead cat bounces occur. Look at the weekly rejection. We got that weekly rejection with the wick. We obviously took the low here on the deliveries day, and then now we're moving back up. If we close another week with a big rejection, you've got to think that's a slight positive. Now, leading into the next kind of 2 days of trade, this is the options expiration expectations in terms of one standard deviation. We've got the weekly high sitting around 119 and the weekly low expectation based on the options market, not what I think, but just, of course, we're going to leave these in the charts for now, 108.25. So one standard kind of deviation is expecting one of these types of moves to occur. What do we think about the market moving forward, though, for Tesla? Well, for sure, everyone's trying to buy puts at 100. The puts at 100 for every single strike are becoming big. This is the options expiration for the 6th of January, 872,000 units. Most congested level is 100. Makes sense. Max Payne, pretty much where the market is right now. If we move forward, though, to the 20th, this is the big options expiration. Have a look at some of the sizings here. Over 3 million units out, and take a look at that 100 put. It seems unlikely that the market is going to go underneath 100 for too long during the month of January. And that's because everyone's so bearish on it that they've all tried to short this thing down thinking 60 is coming. Hey, 60 might be coming, but doesn't mean it's happening right now. And this is the story of the options market right now. Everyone is trying to go puts everywhere, and they're mostly short dated. As you push through to January into February of 2023, you'll notice a big difference here. So you've still got those kind of not really as many hundreds, but suddenly you get a lot of 70s. 70 put becomes a bigger level for Tesla. So it's going to be a very interesting year for this one. Of course, it's compression. Of course, the stock this is all fundamentally driven now. If the stock doesn't meet expectations, watch that compression come in until you see forward PE realistically getting crushed somewhere into that 20 to 22, maybe even lower for a stock like this. It's going to be that type of market for it. Let's move over to Apple and see what our expectations are there. Weekly high 129.39 based on options. Weekly low at the moment is 123, which just so happens to be also the gap fill. So this is a gap that was left behind quite a while ago in terms of the market skipping that area and some orders potentially being left in the system. If we have a look at the weekly here, you can see that Apple is realistically taking a pretty heavy hit. Now, I'd probably expect this to be one of the worst performing leading into Q1 of the big tech stocks. And the main reason is just because we're seeing people tightening up monetarily. iPhones, they're going to potentially show a little bit of weakness. We've got China, of course, opening up, the COVID situation, all sorts of things that you could bring up in those areas. If we look at the charts, though, and what's happening so far, we kind of rallied off this low here, then we moved back down, and then we found some buyers in the last session. If the SP 500 continues to find buyers, which we could expect it may, then Apple could certainly recover. And one of the leading theories that we have is that maybe Apple will break through things like this 132 area and then lead into that 140 with a drop later on throughout January. So definitely don't discount it yet. We'll be looking heavily at this week's close, the weekly close. Look at this. If it manages to wick back up and close above here, that's going to be a fairly bullish sign for the next week, the next potential couple of weeks for Apple. Even though you might have a negative stance on it, that's going to be a big one. What about NVIDIA? Well, one of the things with NVIDIA is it also filled that gap from the CPI number a little while ago, or got very damn close to doing it. And quite a few stocks did this. And then, of course, it's now sitting around that, or hovering around that potential accumulation area for at least a temporary. We're seeing the same thing kind of with Microsoft. It just dropped 4.37%, got down to these lows. And if we put this in perspective, you'll notice that it's kind of back at levels that it could find buyers at. Let's move over to a few other markets. We'll start off with the DAX. Not all markets are equal. The DAX has been heavily shorted by retail, but actually it's been one of the best performers. It's back into that problematic zone, but we don't usually use the DAX as a lead indicator, only very sometimes. It's back at a very key level. I could see even the DAX doing something like this because it's been quite strong due to the types of companies that it holds in that top 40. Let's have a look now at the US 2000, the small caps for the US market. If you have a look at the weekly, this is an interesting closure point. If the market closes bullish, you've kind of got that rounding bottom. So you've got the long leg doji, the rejection wick kind of hammer style, and then do we get a closure above that, detailing that we can go higher before going lower? Something we're looking for here on the markets. Even though we might have the idea that later on the market comes down to new lows, you can't discount what you're seeing on the charts right now, and that is quite a few rejection wicks. Now, if you're bearish and the market goes underneath here, yeah, watch out down below. If it holds a close underneath these levels, it's going to be super significant. So that's about 1,700 on the Russell 2000. Look at the Nasdaq. The Nasdaq's been doing most of the damage to the US market recently. Again, it's come down to those previous levels of, let's say, demand or support. We don't really see too much strength coming out of this market. I'm not using it as a lead indicator at the moment. But certainly it's trying its best to form. Some people have sent this through and said, Tom, do you reckon that's an inverse head and shoulders? Well, if you believe that, then you know where the price is going to be. You're needing an 11,100 kind of breakout, and that to solidify some bullish pressure coming into the US 100. Let's have a look at the Dow. Again, it's holding its current level that we expected it to hold. It's accumulating or potentially distributing. We haven't seen a trap to either side yet. If we do get bang, bang, then we know that it's probably going to rally. If we get like a breakout high with a big wick rejection similar to this one, then we know what's happening next. Very likely it's going to go down. So often we say patience, react, don't predict. At this stage, all we know is this market's coiling. And if you take into account the weekly closures, you could say on some of these markets, it's looking more bullish than bearish, purely because when we take a look at everything in comparison to other times, we do have some wick rejections. Wait around for our SP 500 in a second, and we'll check that out. Let's move over to XLY, XLP. Again, consumer discretionary has been picking up a little bit here in recent days. So even though it's been the most sold off sector, it looks like the market is kind of said, you know what, we're going to start to buy these hated sectors, consumer discretionary, tech. Possibly they're the ones leading the charge if we do get a rally in the next couple of sessions. They've been very heavily sold over the last couple of weeks. Here's the SP 500. We managed to fill one of the first gaps, which was 38.78. So check off your list if you were watching and hearing what we've been saying. That was certainly a good little take profit to the point almost it hit that level. So that gap's now closed and we're left with two new ones. So we've got basically our 39.95, which is still our major theory, or we've got this potential spike of the low, take it, then high. I mean, I like both. If the market comes down, it takes the low, then rejects it with the wick. That's going to be so sneaky. And it's reminiscent of something we've seen before over here. So imagine if that occurs. Bangs, wicks kind of closes. It starts these electric kind of rallies that still end up being bad, especially if the economy is suffering. But that's at least that patience to see the reaction. That could be the trap that's being set. If we do break above 3900, 3910, we know that was a super significant level. You've got to believe 3995 gap fill is very big potential. And part of the reason why all of this exists has to do with the fib pullback that could happen either way. So if we get like a fib pullback to the upside, it's moving towards, look at this, that 39.95, 4,000. What a strong level for it. And if we've got the downside kind of getting set up here, if we put a fib over from the low to the high, you can see that 37.50 getting reached as well. So both levels are incredibly significant zones, we believe here, over the next month to 2 months. If we hit these levels, which we probably expect to hit probably in the next couple of weeks, there are significant zones in these markets. They're gap fills on both ends, and they turn out to be golden ratio levels as well. So it's a bit of stacking of technical analysis there, which should be very interesting. If we go into the 2 hour, do we get any insights to the market? Look, it's all over the place. We haven't necessarily seen too many breakouts either way. We did get a break to the low, which could have been that kind of max pain trap. For buyers, you really want this thing through 3900, 3910. For sellers, you need a closure underneath 3750. If it doesn't wick purchase, yeah, maybe the bears really are back in control. Let's have a look at what the options says for the next month. Well, first up, we'll start with the 6th. Here's the options into Friday. Too many people with random 355 puts, probably not going to make any money. Then we've got the 360s, the 375s. We can see the max pain sitting on the same level, 390 for the call side. Let's move forward though to the 20th to have a look at some of these bigger options. Almost 5 million units. And look at those puts, ridiculous amounts of puts. And this seems to be the battle zone level, 390. So 390 is a big one. And then of course 400, 415, 420s, all of those types of levels. But the puts heavily outweigh the calls in January. So you've got to expect that markets can still continue to kangaroo. And specifically, even though it may not feel like it, kind of you got to lean towards that bullish side at the moment over the bearish side from what the options are telling us about who would make the most amount of money if they all expired. Remember, these are mostly bought by retail, hedge funds, all of those types of things. When too many people are bearish, often the market will sideways to sometimes buy up and hit some levels to trap more people into the call side. We're just not seeing the signs here that allow the market to really consolidate heavily down. Hey, it may happen. It's just not as statistical as it usually is. Let's move over to Bitcoin. Is it giving us any lead indicators? That's having a pretty good session. We're still holding that zone, which is good. And we'd still like to see Bitcoin move towards that 17.5, 17.6 level. And then ideally probably start to struggle around there. We're still probably bearish on Bitcoin for the first quarter here. I do have a special coming up to do with cryptos and Fed pivots, which I think you'll find very interesting. So make sure to subscribe for that. But at this stage, we're looking for Bitcoin through 17,000 and that to hopefully solidify that next 500, 600 move. Watch the space. What's ahead with news coming up? Well, as we know, we had the FOMC meeting minutes. Now we've got ADP non-farm employment change. And then we scroll in here. It's the first week of 2023. And that brings with it non-farm employment change. The big jobs number from the US. Has the economy slowed? Is it still going super hot? We'll find out in this report. It's sure to move quite a few currencies and no doubt the stock market as well. And then straight after that, we have ISM, services, PMI. So some big news ahead for the rest of the week. Be careful out there. There's a lot of illiquidity still in markets, and that can mean large random moves on certain currencies. You do need to be careful of that. Make sure to follow us over at FX Evolution on Twitter. Subscribe, smash that like button if you enjoyed today's video, and we'll see you in the next one. It's great to be back, and thanks so much for joining us for 2023.